Hey class, this is Patrick. Sorry for the inconvenience of having to cancel class. I'm going to go through the chapters in bits and pieces because I don't know how much I'm going to be able to store for each file. We're going to begin with chapter 10, and I'm going to be as succinct as possible while moving through the slides. So I hope this helps. But once again, it's probably best that you go through each chapter and make sure you read it individually as well. For these two chapters, you're going to have a homework assignment which is posted on Moodle. And just to remind you, you're also going to be making up the quiz that we would have had this evening, but we couldn't because class was canceled. We'll make that up next time. So, to begin, we're going to start with chapter 10. Which kind of deals with lessons from capital market history. The last chapter we were discussing required return in a sense, and now we're turning our attention to risk and return. And you all should be fairly familiar with this, given the stock simulator game that we have been playing. So what are some of the key concepts and skills for this chapter? Well, you're going to want to understand how to calculate the return on an investment. We're going to be looking at some historical returns on various types of investments. We'll discuss risks as well on various types of investments. And then we'll get into a little bit on market efficiency and various hypotheses that discuss those elements. The chapter outline looks as follows. First, we're going to get into returns. Then we'll talk a little bit about the historical record. We'll talk about average returns. And then we're going to kind of get into risk by discussing variability of returns. And eventually we're going to turn towards capital market efficiency. Okay, so in a sense, what we've done so far in the class is we've talked about maximizing shareholder value. And what we need to really mention at this point is that I'm sure you've gained this just from following our stock simulator game, that there's a trade-off between risk and reward. And this chapter really digs into that, the fact that there is a trade-off between the two. So this slide's saying that the two key lessons from capital market history: there's a reward for bearing risk, and the greater the potential reward, the greater the risk. Based on our game that we've been playing, you've probably seen that when the market's going up, those who have been taking extreme risks have done quite well. And unfortunately, when the market turns, those who have taken extreme risks may not have done quite as well, and that there's a reason for that. It tends to be the risk-reward trade-off, and that's one of the reasons that, of course, diversification, which we'll get into in later chapters, is important in your market portfolio. But also just an understanding of risk and return is important as well. So getting into returns, dollar and percent returns are an important concept that we're going to discuss. For dollar returns, total dollar return is going to be equal to the return on an investment measured in dollars. So the dollar return would be dividends plus your capital gains. And we've already talked about capital gains, but to remind you of what that means, we're looking at the price received less the price paid. So total percent return is going to be equal to the return on an investment measured as the percentage of the original investment. So another way to think of percentage return is the dollar return over the dollar invested. Here we should emphasize that you don't have to actually sell stock to earn money on paper. The point is that you could. Okay, so let's get into percent return. So we have talked about these in the past, but I don't think we've gone into formulas in regards to them. As far as the dividend yield goes, you can think of for every dollar you invest, you get X cents dividend. So if it's 5%, every $1 invested gets 5 cents dividend. And for every $1 invested for capital gains, in this example, perhaps you get 9 cents capital gains. So the percentage return could be that 5% plus the 9%, the 5% dividend yield plus the capital gains yield of 9%, and you would get 14%, which would be your percent return, 14 cents on the dollar. Now this particular slide goes into a variety of different ways in which you can compute each, and the easiest way to compute the percentage return would just be take that dividend yield plus your capital gains yield. There's an alternative methodology, which you see as the last percentage here, which kind of combines these two formulas into one. So let's go through a quick example here, calculating total dollar and total percentage returns. Let's just say you invest in a stock with a share price of $25, and after a year, the stock price per share is $35, so it's done quite well. Each share also paid a $2 dividend. So the question is, what is your total return? So to start out, let's look at the dividend yield. If you recall back to that formula, the dividend yield was dt plus 1 over dt. So here we're looking at $2, which is your d, over t plus, $2 is the dt plus 1 over the pt, which is your $25. So you'll get 8%. As far as the capital gains yield, you're just looking at the change in the stock price there, and it went from 25 to $35. So that's going to be $10 in terms of dollars. And if you're going to look at that as a percentage change, you take that 10 over your 25 and you get 40. Now to get the total return, we've already discussed the fact that you simply add the two together and you'd get your 48. The alternative way of going about it would be to add the 2 to the 10, which gives you 12, over your same 25, once again 48%. So that's how you would calculate total percentage returns. This next chart, which I believe is probably a figure in your text, yes, figure 10.4, reflects data that figures that are put forth throughout our chapter here. And in it, you can see that large company stocks, S&P 500 index, which is going to contain 500 of the largest companies in terms of total market value in the U.S. You see small company stocks. These are going to be the smallest 20% of stocks listed on the New York Stock Exchange based on market value of outstanding stock. You'll see long-term corporate bonds, which are high-quality corporate bonds with 20 years to maturity. You'll also see long-term corporate bonds, which is a portfolio of U.S. government bonds with 20 years to maturity. And then, of course, you'll see U.S. Treasury bills, which is a portfolio of T-bills with 3 months to maturity. And the clear thing here that you see is the small company stocks in terms of growth, because these are all indexed back in 1925, to, I believe, to about $1. You've seen extensive growth in a $1 investment in small company stocks. It even outpaces large company stocks. And then as you move down, you see long-term government bonds, you see treasury bills, and then you see inflation, where treasury bills are just outpacing the growth in inflation. And that's not always true. I mean, you could look at this chart real quick and ask yourself a question. I know it's dated. It's only from 1925 to 2008, but it still provokes an interesting question. And I think the question would be, why would you ever invest in anything other than small company stocks based on a chart like this? And the answer is pretty straightforward. The answer is risk. With these small company stocks, yeah, you might receive the biggest growth, but you might be taking part in more risk. So that brings us to our next slide here, which is figure 10.5 in your text. And here we're seeing, if you look at the top part of this bar and you just kind of go across and try to figure out a kind of an average, you'd see about, I would say, 40% as far as your high marks and around 40% for your low marks. And this is looking at large company stocks. And in particular, what we're looking at here is year-to-year total returns on large company stocks. So total annual returns are about 40% in the good years, these blue years, and in the poor years, you can see here during the Depression, it went down 40%. In our most recent recession, it went down roughly 40%. So with highs, you saw about plus 40%, maybe about 50%, and lows of a little bit above 40% for large company stocks. If we do the same thing with government bonds, you can see that in the early 80s, there were really some good years here, as these long bars tended to reach, in some cases, around 40%. But the risk, or the negative years, these purple bars, on a really bad year, they'd get around 10%. So that's long-term government bonds. You should also take a note. We don't have a slide for it, but to take a look at the chart in the text for small cap stocks. And what you'll see for the small cap stocks relative to these, here it's about 40% in terms of growth, and for the large company stocks, it was about 40-50% in terms of growth. Small cap stocks, largest was like 150. So you can get the picture that there was extensive growth there. How about for Treasury bills? Well, with Treasury bills, you have annual returns in around the 80s of 14%, but much lower returns in general. So all of this information that we just looked at, it's way too complicated to really dig into without summarizing in some sort of way. So this next chart does that. It takes an average over the life of that 1926 through 2008 and looks at all of those returns. If you recall, some of them were negative, some of them were positive. The large company stocks over average was 11.7%. Small company stocks, which you didn't have a slide on but is in your textbook, and I said, had growth in some cases of 150%, on average was growing about 16.4%. Corporate bonds, about 6.2%. Long-term government bonds, 6.1%. U.S. Treasury bills, 3.8%. And inflation, 3.1%. So the key here is we're looking at return. So in general, small company stocks are putting forth the best returns over that time period. However, if we're just talking, that's just speaking about returns. So the historical average return is pretty straightforward. What they were computing there was a simple or arithmetic average. They were taking, each and every return from 1926 through 2008 and then dividing it by the number of years. So they summed the returns for large company stocks from 1926 through 2008, and then they divided it by 83 years, and they came up with 11.7. So that's an example. However, when we're talking about returns, we're not really taking into account risk. Let me try to adjust this camera a little bit. And this next chart starts to go into risk premiums. Now, a lot of people consider there to be a risk-free rate in a sense, and Treasury bills are considered to be risk-free to an extent, depending on who you talk to these days, but in general are considered to be relatively riskless. Whereas when we get into some of this other stuff like those small cap stocks or small company stocks, you're going to see that it's typically thought that they are very risky. So a lot of times people will compare the risk of a risk-free rate relative to a risky rate. And I'm gonna take a quick break here, and I'm gonna catch back up in a second.